The role of banks in economic development. Banks play a pivotal role in the economic development of nations by acting as financial intermediaries, facilitating the flow of funds from savers to borrowers. Their significance lies in their ability to channelize resources efficiently and support various economic activities. In this text, we will delve into the multifaceted role of banks in promoting economic development, touching upon essential concepts and mechanisms. At the core of a bank's role lies the critical function of financial intermediation, a sophisticated process through which these financial institutions skillfully bridge the divide between entities possessing surplus funds and those seeking capital infusion. This intricate mechanism forms the backbone of a dynamic economic system, orchestrating the efficient flow of funds from areas of abundance to regions requiring financial nourishment. In essence, banks act as the conduits that channelize the financial currents, ensuring that the reservoirs of savings find their way to fertile grounds where they can germinate into productive investments. This strategic alignment of surplus and deficit units orchestrated by banks serves as the bedrock for optimal resource allocation within an economy. By identifying and directing available funds towards ventures with the potential for growth and development, banks become architects of economic progress. This meticulous allocation of resources, facilitated by financial intermediaries, propels the expansion of industries, the establishment of new enterprises, and the enhancement of existing ones, creating a ripple effect that resonates across the economic landscape. In this symbiotic relationship between surplus and deficit units, banks function as catalysts, fostering an environment conducive to economic growth. As surplus funds, often dormant in idle accounts, find purposeful avenues for investment, they stimulate the wheels of production and consumption. Entrepreneurs, armed with the necessary capital, embark on ventures that generate employment, contribute to technological advancement, and spur innovation, thus adding layers to the fabric of economic vitality. The role of banks in financial intermediation extends beyond the mere facilitation of transactions. It encompasses a judicious evaluation of risk and return, where financial institutions act as vigilant custodians of the funds entrusted to them. Through thorough risk assessments, banks ensure that funds are directed towards ventures with sound prospects, thereby minimizing the likelihood of financial instability. This risk mitigation function is crucial for sustaining economic growth over the long term, as it safeguards both the interests of depositors and the stability of the financial system. Banks, as financial architects, wield considerable influence in the realm of capital formation, playing a pivotal role in transforming latent savings into powerful engines of economic development. The process begins with the adept mobilization of savings from diverse sources, including individuals diligently stowing away portions of their earnings and institutions strategically managing their financial portfolios. In this intricate ballet of financial aggregation, banks emerge as the choreographers, seamlessly orchestrating the convergence of saving streams into a reservoir of capital ready to be deployed for the greater good. Once these savings are amassed, banks take on the crucial responsibility of steering this consolidated capital towards avenues that promise not just returns but also contribute substantively to the economic fabric. The directional flow of these funds, akin to the irrigation of arable land, is meticulously managed to ensure that they irrigate sectors with the potential for sustained growth. Infrastructure projects, regarded as the backbone of economic progress, stand as prime beneficiaries. Whether it be the construction of highways that connect cities, bridges that span rivers, or power plants that illuminate entire regions, banks serve as the financial conduits, facilitating the transformation of savings into tangible infrastructural assets. Industries, the beating heart of economic activity, also reap the benefits of this mobilized capital. Banks provide the lifeblood, in the form of loans and investment capital, that allows industries to expand, innovate, and remain competitive in a dynamic global market. The resulting surge in industrial output not only propels economic growth but also generates employment opportunities, fostering a cycle of prosperity that extends beyond the boardrooms of corporations to the homes of workers. The outreach of banks extends to the grassroots, where small businesses, often the backbone of local economies, find sustenance. By directing savings towards these enterprises, banks become catalysts for entrepreneurship and innovation. Small businesses, armed with the necessary capital, can navigate the challenging terrain of market dynamics, create jobs, and contribute meaningfully to the economic tapestry at a micro level. Among the myriad roles that banks assume in the economic ecosystem, the provision of credit stands as a linchpin, a catalyst that propels businesses and individuals toward growth and prosperity. This fundamental function encapsulates the essence of financial empowerment, as banks extend loans to entrepreneurs, acting as enablers for the realization of ambitious ventures and the expansion of existing enterprises. At its core, the extension of credit by banks translates into a lifeline for entrepreneurs, providing them with the necessary financial impetus to turn their ideas into tangible realities. Whether it's a visionary startup seeking its initial capital injection or an established business eyeing expansion into new markets, banks serve as the financial architects, assessing risks and opportunities to tailor loan packages that suit the unique needs and aspirations of each borrower. This infusion of capital empowers entrepreneurs to invest in technology, acquire resources, and scale operations, thereby fostering increased production and efficiency. The ripple effects of this credit infusion extend beyond the boardrooms of businesses, permeating the broader economy through the creation of jobs. As entrepreneurs leverage bank loans to expand their operations, the demand for skilled labor intensifies, resulting in a surge of job opportunities. This symbiotic relationship between credit provision and job creation lies at the heart of a flourishing economy, with banks assuming the role of economic catalysts, stimulating growth not merely through financial transactions but through the tangible impact of increased employment and income. The provision of credit is a double-edged sword, and the prudent management thereof is paramount for sustained economic growth. Banks must meticulously balance the imperatives of risk and reward, conducting thorough risk assessments to ensure that loans are extended to enterprises with robust business models and growth potential. Effective credit management safeguards against defaults and financial instability, fortifying the financial sector's resilience and, by extension, the broader economic landscape. Banks play a pivotal role in mitigating various financial risks. Through diversification and careful risk assessment, banks ensure a stable financial environment, safeguarding both depositors and investors. This risk mitigation is crucial for sustaining economic development in the long run. Central banks, revered as the custodians of monetary stability, play a pivotal role in shaping the economic landscape by wielding a set of sophisticated tools collectively known as monetary policy. These regulatory bodies, entrusted with the oversight of commercial banks, exercise their authority judiciously to navigate the complex currents of the financial realm, with the ultimate aim of fostering macroeconomic stability and ensuring the compass of sustained development points in the right direction. At the heart of this regulatory endeavor lies the intricate orchestration of monetary policy tools. Central banks deftly maneuver interest rates, a linchpin in the economic machinery, to influence the cost of borrowing and lending within the banking system. By adjusting these rates, central banks effectively modulate the incentives for businesses and consumers to either save or spend, thereby sculpting the contours of economic activity. This nuanced dance with interest rates serves as a lever to control inflation, a formidable force that, left unchecked, can erode the purchasing power of a nation's currency and disrupt the delicate balance of economic equilibrium. In addition to interest rates, central banks deploy open market operations, a strategic buying and selling of government securities, to influence the money supply in circulation. This meticulous calibration of the money supply serves as a potent tool in steering inflation and controlling the overall economic trajectory. By fine-tuning the availability of money, central banks act as economic architects, shaping an environment where prices remain stable, fostering investor confidence and encouraging long-term investments. The transmission of these monetary policies unfolds through the intricate network of the banking system. Commercial banks, as the conduits through which monetary policy exerts its influence, become integral partners in the realization of the central bank's objectives. Through adjustments in policy rates and open market operations, central banks influence the interest rates at which commercial banks lend to businesses and individuals. This ripple effect, extending from the boardrooms of financial institutions to the daily lives of consumers, contributes to the regulation of economic activities, ensuring a harmonious interplay of supply and demand. Banks play a crucial role in financing large-scale infrastructure projects, such as highways, bridges, and power plants. These investments not only create jobs but also enhance the overall productivity of the economy by improving transportation, energy, and communication networks. Banks facilitate international trade by providing trade finance services. Letters of credit, export financing, and foreign exchange services offered by banks facilitate cross-border transactions, promoting exports and imports, and contributing to economic growth. The banking sector, traditionally known for its resilience and adaptability, has undergone a transformative evolution propelled by the relentless march of technological advancements. In this digital era, financial institutions have not merely embraced change but have become architects of innovation, ushering in a new era marked by online banking, mobile payments, and digital lending platforms. These technological innovations, akin to a digital revolution within the financial domain, have woven a tapestry of efficiency and inclusivity that extends far beyond the conventional boundaries of banking. Online banking stands as a hallmark of this technological metamorphosis. The advent of secure and user-friendly online platforms has liberated banking from the constraints of brick-and-mortar establishments, placing financial services at the fingertips of consumers. Whether it be checking account balances, transferring funds, or paying bills, individuals now enjoy the convenience of managing their financial affairs with unprecedented ease and speed. This paradigm shift not only enhances customer satisfaction but also streamlines operational processes for banks, fostering efficiency and cost-effectiveness. Simultaneously, the rise of mobile payments has transformed the way transactions occur in the contemporary financial landscape. Mobile wallets and payment apps have become ubiquitous, providing users with a seamless and instantaneous means of conducting financial transactions. The ubiquity of smartphones has democratized access to financial services, reaching even the unbanked or underbanked populations in remote corners of the world. This democratization not only promotes financial inclusion but also injects dynamism into economies by amplifying the velocity of money circulation. Digital lending platforms represent yet another frontier in the technological renaissance of banking. These platforms leverage sophisticated algorithms and data analytics to streamline the lending process, offering faster approval times and more personalized loan products. Small businesses and individuals, who may have faced barriers to traditional lending, now find themselves welcomed into the financial fold through these digital avenues. This democratization of access to credit not only empowers entrepreneurs but also fuels economic development by channeling funds to where they are most needed. The confluence of these technological innovations transcends the mere realm of convenience. It catalyzes a paradigm shift towards a more inclusive financial system. By reducing transaction costs, eliminating geographical barriers, and extending financial services to previously underserved demographics, technology-driven banking fosters economic development on a broader scale. The efficiency gains realized by financial institutions through these innovations translate into cost savings, which, in turn, can be redirected towards more strategic investments, further fueling the engine of economic progress. However, as the banking sector hurtles towards a technologically driven future, it is crucial to navigate the associated challenges, such as cybersecurity threats and digital divides. Striking a delicate balance between innovation and security will be paramount in sustaining the positive impact of these technological advancements on economic development. The integration of technology into the banking sector has not only revolutionized the way financial services are delivered but has also become a catalyst for economic development. The efficiency, accessibility, and inclusivity brought about by online banking, mobile payments, and digital lending platforms are transforming economies, empowering individuals and businesses alike, and charting a course towards a more interconnected and prosperous financial future.